55% of deals that make it all the way to diligence never close. And the worst part, the buyer never calls to tell you why. They don't say we found a problem. They just go quiet. One more call, one more document request, one more week of enthusiasm. Then the emails slow down. The questions get more specific. And somewhere in that process, the buyer stops believing the business matches the story. That silence is killing more deals than bad multiples, market crashes, or financing failures ever do. Because the real reason isn't money. It's that the buyer looked closer and the business didn't match the story anymore. Here's the mistake almost every founder makes. They think the LOI means the hard part is over. It doesn't. It means the buyer has decided to stop trusting the story and start testing the reality. In the next 20 minutes, I'm going to show you the 3 real reasons buyers disappear, the exact moment in the process where most deals actually die, the buyer types that predict when silence is coming, and the 8-variable checklist that catches problems before the LOI even goes out. If you're a founder who's ever been ghosted in diligence, this is the video you need to watch before your next process. Let me walk you through what this looks like in the real world. A typical deal in the $1 to $3 million EBITDA band starts with a CIM. You've spent months preparing it, you've taken the calls, you've fielded the offers, you've negotiated the multiple. Then the LOI lands in your inbox. And that feels like a decision. It feels like commitment. It isn't. The LOI is not the finish line. It's the starting gun for the part where the buyer stops buying the story and starts testing the business. Before the LOI, the buyer is deciding whether he wants to look. After the LOI, he's deciding whether what he finds matches what you told him. That distinction costs founders more deals than almost anything else in this market. Let me walk the timeline once so you feel the weight of it. In the $1 to $3 million EBITDA range, a deal averages 9 to 12 months from first contact to closing. The exclusivity period alone can run about 106 days. Before a buyer walks away from anything, he's already committed $25,000 to $75,000 in diligence costs, advisor time, and legal fees. That's real money against a deal he hasn't closed. Which means when he does walk, something genuinely changed his mind. What changes it, more often than anything else, is the gap between the story in the CIM and what an independent accountant finds when he actually looks at the books. Think about what a CIM is. It's a document a banker built to tell the best, honest version of your story. 3 years of revenue growth, adjusted EBITDA with add-backs, explained. Margins trending in the right direction. It's designed to attract interest, and it works. The problem is that a QOE firm isn't reading your CIM. They're reading your QuickBooks file. QOE EBITDA discrepancies more than doubled between 2023 and 2025, from 10.6% to 21.3% of broken LOIs. That means roughly 1 in 5 deals that die in diligence die because the financial story failed contact with an independent accountant. And the pattern isn't fraud. It's something quieter than that. Let me give you a real example. A residential and commercial contractor in the Southeast had delivered more than 10% annual revenue growth for 5 straight years. EBITDA had grown from $1.2 to $2.7 million. The banker was already in market. The story was clean and the trajectory was real. No work in process schedule had ever been built. Management didn't think they needed. 1, billing felt current, margins felt consistent, growth felt verified. Then the QOE firm evaluated margin on all jobs at the cutoff dates and found 2 problems. First, residential jobs consistently incurred costs in one period and billed in the next, which compounded across a growth cycle into a nearly 10% EBITDA adjustment in year 3. Painful, but manageable. The second problem wasn't manageable. 2 commercial contracts, both substantially completed in year 2, had been billed in year 3. When the QOE firm moved that revenue back to where it actually belonged, more than $1.1 million shifted out of year 3. 30% of expected EBITDA disappeared in a single adjustment. The lender's debt service coverage model stopped working. The seller had to carry a larger note than he'd mentally lived with for months. The founder didn't lie, he just never built a WIP schedule, and cash basis books with no reviewed statements couldn't catch what accrual accounting would have shown immediately. Here's the founder mistake. They thought accounting was a formality. It's not. It's the first real test of whether the business is what it says it is. Cash basis books, aggressive add-backs, no reviewed statements. These aren't fraud. They're silent deal killers. Most founders don't know they're carrying into a process. QE failures are the most visible breakdown in diligence. They're not the most common one anymore. So if QA failures are the most visible breakdown, here's the one that's actually ending more deals. Findings that never showed up in a financial model because no financial model would ever think to look for them. Non-COE diligence findings are now the single largest cause of broken LOIs in the lower middle market. 25.3% of broken deals in 2025, up from 19.1% 2 years earlier. And the reason they're so dangerous is that they're not errors. Nobody miscalculated, nobody left something off a schedule. These are structural facts about the business that the founder stopped seeing years ago because he built the business around them. The buyer walks in and sees them immediately. Start with the most common one. 42% of deals entering diligence have a single customer above 25% of revenue, nearly half. A California-based business services company made it all the way to LOI with a family office buyer. Revenue was up. EBITDA was defensible. The financial story held. Then diligence surfaced the concentration. 40% of revenue coming from a single government sponsorship in California, renewing entirely on someone else's decision. The buyer's exact words. Too much risk, with 40% of revenue coming from government sponsorship in California. That was it. No negotiation, no restructuring path. The revenue was real, and the deal was dead. The founder had run that business for years with that government relationship as a feature, not a liability. He delivered on every contract renewal. To him, it was proof of quality. To the buyer, it was proof that 40% of the purchase price could disappear without the seller doing anything wrong. Here's the founder mistake. You normalize risk over time. You stop seeing it because you've lived with it for years. The buyer sees it immediately, and they don't negotiate past it. Contract assignability works the same way. A company with $25 million in revenue nearly lost its deal when diligence revealed that 10 key contracts, the ones driving essentially the whole business, had no assignment provisions. In a change of control transaction, unassignable contracts mean counterparties can walk. And if they walk, the revenue the buyer underwrote walks with them. The deal survived, but only after legal remediation, extended timelines, and weeks of trust erosion between parties that had already agreed on price. Every week spent fixing something the seller didn't know was broken is a week the deal could have died. Key employee departure risk shows up in 31% of deals entering diligence. Undisclosed legal or regulatory exposure in 18%. The manufacturing deal that terminated the moment criminal charges surfaced on a principal is the extreme version of that second number. But the outcome is identical across the range. Binary, no restructuring path. The deal is over the day the finding lands. The full picture from Axial's 2025 dataset looks like this. Customer concentration above 25% to 42% of deals. Declining or flat revenue in inflation-adjusted terms, 38%. Key employee departure risk, 31%. Undisclosed legal or regulatory issues, 18%. Environmental or facility concerns, 12%. Read that list again slowly. None of those are accounting problems. None of them would appear on a QOE report. A banker building a CIM wouldn't include them because they're not line items. They're operating realities the founder normalized over time because he had to. The customer who became 40% of revenue didn't get there overnight. Those key employees who never signed contracts were there before anyone thought contracts mattered. The legal exposure accumulated quietly while the founder was focused on growth. That's what makes this category so hard to see coming. These aren't mistakes. They're features of a business that worked, built by someone who made it work. And the buyer can't normalize what the founder stopped questioning a decade ago. Buyers finding structural problems in a business is one thing. But what happens when the founder himself is the variable that breaks the deal? 13% of broken LOIs in 2025 trace back to a single variable nobody modeled. The seller changed his mind. Not the numbers, not a structural finding. The person who built the business, ran the process, negotiated the term sheet, and sat across from the buyer for months. He pulled out. And that number is consistent enough across deal types, buyer types, and industries that treating it as a personality quirk is a mistake. It's a diligence variable, and buyers who don't treat it that way pay for it later. An M&A attorney described a 9-month middle market transaction where both sides had reached the finish line. Attorneys engaged, docs drafted, every party ready to close. The seller walked away, not because price changed, not because anything surfaced in diligence. He chose to absorb the financial penalty from breaking the agreement rather than sign. No counteroffer, no renegotiation, just done. The buyer, the attorneys, the advisors, everyone wrote off the time and fees with no explanation that made sense from the outside. The thing is, it makes complete sense from the inside. Think about what diligence actually is from the seller's seat. You've built something over 10, 15, sometimes 20 years. Every operational decision you made is now being audited by people who've known your business for 6 weeks. Your customer relationships, your compensation structure, your accounting practices, your key hires, all of it reviewed by strangers whose job is to find problems. The process is designed to surface risk, which means the buyer's team spends months looking at your business the way a prosecutor reviews evidence. Most founders go into that feeling like partners. A lot of them come out feeling like defendants. The Axial 2025 dataset has 3 quotes that say it plainly. The seller was not on board with the post-acquisition strategy. Search fund, healthcare deal. The seller pulled it off the market. Family office, healthcare deal. The sellers ultimately decided to pause any transaction, citing market uncertainty in solar and a strong internal preference to remain independent. Independent sponsor, industrial services. Read those 3 and you notice something. None of them happened because the deal was bad. The businesses were real, the buyers were real, the multiples were real. The seller just reached a point in the process where finishing cost him more emotionally than walking did financially. Here's the founder mistake. You think you're emotionally ready to sell until you're not. Now here's the cost that doesn't show up in that moment. A business with a prior failed marketing attempt gets 25% fewer offers when it comes back to market. And the offers it does get arrive at valuations roughly 12% lower. The seller who walked away didn't just burn that deal, he discounted the next one before it started. Buyer behavior already reflects this. Family offices exit broken deals in an average of 37 days, the fastest of any buyer type. The reason isn't that they move carelessly, it's that they qualify seller motivation early and directly without an investment committee between the decision and the conversation. They don't spend 106 days discovering the seller wasn't ready. They find out in week 5 and move on. Seller motivation isn't a soft variable. It's the first one worth underwriting. So you now know what breaks deals. The question nobody asks until it's too late is who's sitting across from you and how long are they going to stay before they go quiet? Axial's 2025 dataset broke every failed deal by buyer type, and the differences in average days under exclusivity aren't just statistics. They're a map of how each buyer type processes risk, at what point they stop trying to fix something, and when the silence you're about to experience actually starts. Begin with independent sponsors, because they're the ones founders most often misread. They offered the highest average multiple on failed deals in the dataset at 5.42x, and they stayed in exclusivity the longest before walking, averaging 129 days. That combination feels like commitment. What it actually reflects is a buyer type that pushes through problems longer than anyone else in the room, which means when an independent sponsor finally concludes a deal is unsalvageable, he's already absorbed more cost than any other buyer type. The patience isn't protection. It's the reason the write-off is bigger when it ends. Search funds move differently. They offered the highest multiples of any buyer type at 5.82x on average, but broke deals at 70 days well before an independent sponsor gets uncomfortable. The reason is structural. Search funds run on equity financing, so when the lead investor reprices after diligence, there's no internal capital to absorb the gap. One healthcare deal in the dataset shows exactly how fast this happens. The lead equity investor reconsidered competitive dynamics post-diligence, got uncomfortable with evaluation, and the deal collapsed without the seller ever fully understanding what changed. 70 days in, QOE, already paid for, nothing to show for it. Family offices exit in 37 days on average, the fastest of any buyer type, and the California concentration deal from the last section is the cleanest example of the logic. Clean financials, real EBITDA, one structural fact that conflicted with how they think about risk. They saw it, made the call internally, and moved on inside 5 weeks. No investment committee, no extended deliberation. When their conviction goes, the deal goes with it, and it goes fast. PE firms sit at 106 days, the same as the market average for failed deals overall, and they're the buyer type most likely to attempt renegotiation before walking. 14.7% of broken LOIs involved renegotiation challenges, and PE behavior drives most of that number. They find a problem, model the impact, propose a price adjustment, and give the seller a chance to meet them. When the seller won't, or when the gap is too wide, they walk. But they try first, which is why they stay longer than search funds and still exit before independent sponsors. Senior lenders are the longest at 159 days, and that number should make any seller nervous for a specific reason. The transportation deal, where a lender repriced at closing, after diligence was complete, after both parties were aligned, happened because credit committee processes run on their own timeline, often surfacing issues at the exact moment everyone else thought the deal was done. 159 days is not patience. It's a system with multiple checkpoints, any one of which can stop the process cold. Healthcare commands the highest multiples on failed deals at 6.21x because regulatory findings surface late after months of committed work. Transportation takes the longest at 134 days because contract complexity compounds every other variable already in play. Knowing your buyer type doesn't prevent the silence, but it tells you exactly when to expect it and which problems are most likely to trigger it. The 70 to 80% failure rate is a market level number. It's not a law of nature. Top tier LMM advisors achieve closure rates around 90%, and the gap between their results and the market average isn't access to better buyers or stronger deal flow. It's preparation, specifically the kind that removes the exact failure modes we've covered before a deal ever reaches LOI. Here's the reframe worth sitting with before we get into the specifics. Every deal that died in the examples above broke on something that was already present before the process started. The WIP schedule that didn't exist, the customer concentration nobody flagged, the key employee who never signed a contract, the seller who hadn't fully decided. None of those problems appeared during diligence. Diligence just introduced a buyer who cared about them, which means the entire failure was detectable before exclusivity started. 8 variables separate businesses that close from businesses that don't, and they map directly back to what killed the deals we've been through. 3 years of reviewed or compiled financial statements, not cash basis QuickBooks, actual reviewed statements, no single customer above 25% of revenue. All material contracts reviewed for change of control provisions before the process launches, operations functional without the founder's daily involvement. Asking price within 15% of market comparables. IP ownership clearly assigned rather than sitting informally in someone's knowledge. Key employees under written contracts. No unfiled tax returns, undisclosed regulatory exposure, or misclassified workers. That's 8 items. Most founders running a 7 or 8-figure business can clear most of them in 60 to 90 days with the right advisor, and the math on doing that work early is not close. Businesses with complete financial documentation receive 2.3 times more offers than those without, and achieve 15 to 20% valuation premiums. Third-party valuations generate offers 40% faster and land at 92% of asking price, compared to 78% without one. Pre-sale work that clears these 8 variables runs $15,000 to $35,000. The buyer side write-off on a deal that dies in week 10 starts at $25,000 and runs to $75,000, and that's before you account for the relisting discount. That discount compounds fast. When a business comes back to market after a failed attempt, it arrives with 25% fewer offers and a 12% valuation haircut already baked in. The seller who decided preparation was too expensive finds out the real cost 6 months later at a lower number with fewer people in the room. For buyers, the sourcing implication runs the same logic in reverse. Deal flow filtered for these 8 variables isn't just higher quality, it's the only sustainable model, because relisted businesses with prior failures are 25 to 30% harder to close and carry a discount that reflects everyone's awareness of why they're back. The silence of diligence isn't random. It follows a pattern, and the pattern is visible before the LOI gets signed. Here's the founder mistake. You wait until LOI to fix these things. By then, it's too late. The gap between enthusiasm at LOI and silence at closing is almost always visible in advance. Buyers just rarely look before they're already in. Before your next LOI, not after the QOE starts, before the term sheet goes out, run those 8 variables against the target. That's where the deal lives or dies. The founder, who thought buyers loved his business, wasn't wrong about the enthusiasm. He just didn't know what buyers were actually looking for once the room went quiet. Now you do. Earlier in this video, we walked through the 8 variable checklist that separates closable deals from ones that die in week 10. But knowing the checklist and building the filter before exclusivity starts are 2 different problems. The next video covers exactly how to qualify a deal before you're in it, so you're not spending 106 days finding out what 5 days of prep would have told you. Watch it next. The silence at LOI is usually not random. It's a reaction to something that was there all along. So before your next deal goes live, run the 8 variable test, because the best time to find the problem is before the buyer does. And once you understand that, you stop losing deals to silence. You start preventing it. Earlier in this video, we walked through the 8 variable checklist that separates closable deals from ones that die in week 10. But knowing the checklist and building the filter before exclusivity starts are 2 different problems. One of the biggest issues we identified was customer concentration. 42% of deals entering diligence have a single customer above 25% of revenue. That's not just a diligence problem, it's an exit strategy problem. If you're building a business to sell, you need to think about how your buyer mix, revenue structure, and growth trajectory position you for the right buyer from day one. That's exactly what we cover in our next video: how to pick winning exit strategies. Most founders spend years building a business and then leave serious money on the table when it's time to sell. Not because the business wasn't good enough, but because they were unprepared for how sophisticated today's buyers have become. This video breaks down the 3 strategies that separate founders who walk away with everything they built from the ones who spend the rest of their lives doing the math on what they could have had. If you're thinking about an exit in the next 2, 3, or 5 years, what you learn in the next 20 minutes would be worth more than almost anything else you do this year.